Welcome back, everybody. We are back again with another video, and in today's video I will be going over how to perfect your swing trading, and it will be an example of an AUDJPY trade breakdown overviewing the market maker buy model as always. So before we get into the video, I kind of want to clear up some FUD in the prop firm space. If you guys are looking for a prop firm to use or trade, I would always recommend utilizing Prop Firm Match, because this is how I've been finding my prop firms to trade as of recently, given the fact that we have had, for at least US clients, I haven't been able to trade on MetaTrader, but this actually helps my way to find new prop firms that are trustworthy to use. If I simply go about my process and I pick my 200K account, my two-step, and then I click United States, where I'm from, I hit search, it gives me the full list of prop firms that I can choose to trade from. And the best part about it is the reviews. If I click on any one of these prop firms, it will give me a full-blown trustworthy review of someone that has passed a funded account and also have received payout. Make sure you're utilizing the exclusive offers tabs just to keep in touch with all of the prop firms that offer the best deals for your liking. So moving forward, if I ever have any sort of interest into expanding my horizon to allocate more funds from prop firm capital, I would always use Prop Firm Match to search for a new company. If you are interested, I'll leave a link to this website in the description of this video. So the importance of understanding swing trading and holding positions longer than a day or even a couple of days and maybe even a week. You want to basically make sure that you're in sync with higher time frame order flow and where the external range draw and liquidity is. Now look at this chart for the Japanese yen futures, and you tell me what the higher time frame is depicting on this chart. So with my annotations here, you can see that order flow has been bearish. And if we're incorporating our internal and our external range liquidity, price reached an internal range liquidity pool and rejected off of it, now drawing and respecting the higher time frame order flow, drawing down to the external range liquidity pool low, resting here. Now if JPY futures are bearish, that would mean anything that is XXX JPY would be bullish. So as long as the yen futures are bearish, I am confident to say that anything that is crossed with the yen will continue higher. Now here is a daily chart on AUDJPY on the left and NZDJPY on the right. Now look at what I always do in regards to correlated lows and highs and imbalances too. Mark off what you see in regards to SMT, internal or external range liquidity, just before I show my annotations on the next slide. Now I know I broke down a trade previous week on AUDJPY weekly internal to external range. So we've actually been strong on Australian dollar compared to New Zealand dollar for quite some time. You can see here we made the higher low on AUD and the lower low on NZD. And if you look here too, price reaching our internal range liquidity pool and creating SMT inside of that internal range liquidity pool. So we have our step 1 and 2 checked off of our list. So our priority will be AUDJPY compared to NZDJPY, because you can see the lower lows being made compared to the higher lows being made on the daily time frame. So the daily will be subordinate to whatever happens on the intermediate term perspective. So that is what I'm going to frame my long trade off of, because of AUDJPY tipping its hand off to me on the higher time frame. And I alerted this in my Discord. I was looking at the same thing. Once price reached that internal range liquidity pool, I was looking at AUDJPY daily to hourly chart, utilizing the NFP highs as a low-hanging fruit objective point for that trading week to frame an hourly market maker buy model to the NFP resting liquidity highs. Now, one thing to keep in mind here is the fact that our external range draw liquidity is all the way resting here. I'm using any internal highs, like the NFP highs that I labeled on the hourly here, as the low-hanging fruit for anything that I could take for a 1 to 2 risk to reward, so that I could leave 20% of the position open running to respect our daily internal to external range draw and liquidity. Because you guys know that our long-term draw is 104 961. Now, based off of our hourly chart, I have the internal range liquidity pool marked off here, and I have the SMT inside of the internal range. Now, this is the start of the new week. Here is Monday at midnight and Monday at midnight for AUDJPY, and the NFP highs on both correlated assets. Mark off now, starting from the beginning of the week until the price that we have traded. Notice the correlated highs and correlated lows to identify our SMT divergence, to then pay attention to price to draw into the buy side liquidity pool that I have marked off. And I'm assuming you marked it off correctly, because you could see AUDJPY made the lower low, NZDJPY made the higher low. But just because the hourly chart shows us the stronger asset for NJ compared to AJ, that doesn't mean that I'm just going to automatically flip and be like, all right, the hourly is giving me strength out of NZD compared to AUD. I'm going to stay true to what the daily and the weekly have been telling me. The strength on the higher time frame will be subordinate to what the strength is telling me on the lower time frame. So after this SMT was created and it was AUD cash rate, red folder news, this was our Judas swing clearing short-term lows. That creates the SMT. Now I'm going to wait to see what our reaction is after the SMT is created after that red folder news event. So our reaction after price creates the SMT, we had that down close candle that initially swept all the lows and created the SMT. This was our labeled order block that I would be waiting for a close above for a change in state of delivery. So if I wanted to get in a first initial execution, but I didn't do this execution, I waited for the next day, price would tap the order block, and then I'll put my stop loss at the body lows of that OB. And my take profit for a 1 to 2 would be the NFP resting liquidity high here. So just moving forward and the reaction off of that order block, you could see price is staying inside of this down close candle, and we're also not violating the mean threshold of it by no closures below. So we had a wick that's completely fine. This is just another run on the buy stops, creating another intermediate term low, but this intermediate term low did not have SMT, but it still has market structure aligning itself with the draw on liquidity. So if you did enter here, or if you waited for the stop run here off of this order block that ran liquidity and then broke structure after, that is completely fine too. But what we want to understand is what you always want to have your stop loss placed where the SMT occurs. Like my stop loss always rested right at the bodies of this low that created the SMT. And then once price wants to push and move away, I can slowly but surely inch my stop loss up, reducing my risk. But when price reaches my 1 to 2 risk to reward, I take off 80% of my position and I leave 20% of it running to external range targets, because we're only trading to the highs of NFP. And you guys can see that high is resting right here. We have hundreds of pips to go until we actually complete an internal to external range move. So 104.961 is still on the horizon on that daily chart. But my priority is capital preservation, so I want to make sure that I'm locking in some sort of profit and then protecting myself so that I can let the rest of my position run free, but I'm still confident in what the higher time frame draw on liquidity is, because I'm letting myself be in alignment with higher time frame order flow. Now following that, you could even see the hourly chart. We closed above this down close candle, and this was our labeled breaker block. So even if you wanted to add more to the position, you could have done it there with a stop loss at any of these resting lows or swing lows, and then pushing finally to clear our resting buy side liquidity pool draw for an hourly completion of a market maker buy model en route to our daily external range liquidity pool. So this resting high was when I closed 80% of my position and I locked in 1 to 2 risk to reward. And I entered in twice on this open position. I closed the full at 1 to 2, and then I left the other position open, which was 20% to resting highs. I closed the majority, half another piece at the rejection block on that daily chart. And now the last piece of the position is running until those daily external range highs. So when you're just confident in higher time frame draw and your trade is based off of what higher time frame order flow is telling you, and you're trading the continuation and not the reversal, you can confidently leave runners to external range targets and catch these 100, 200, 300 pip moves. And when you see those swings that I take on Twitter, 9 times out of 10, it's just a runner that I left after already securing profit at a 1 to 2. That is just me confidently knowing where the higher time frame is telling me price is drawing to. But I hope you guys learned something in this video. I hope it can allow you to be more confident in holding runners and letting a piece of your position go to external or internal range targets. But I hope you enjoyed. Like always, I'll see you guys again next week in the next upload.